Hello again and welcome back.
After determining the capitalized cost of a long-term asset, then we must begin what we call the allocation of that cost of the asset to expense over its useful life. But what we're really referring to here is, the asset is diminishing in value. And in many cases, it's effectively being used up. I mean, how long does a car last or a truck last? I mean, it doesn't last forever. But over that period of time, you're effectively using up the value of that asset. And theoretically, if that's happening, we ought to be crediting the asset for the amount that's diminished or used up. And the using up of any asset, it represents a cost of incurred in operating the business, as we're using this delivery truck in our business to deliver our product to customers. If you're using up an asset in the course of your business, it's an expense. That's the definition of an expense. So we'll need to credit asset and debit expense over time as we use up or utilize these long-term assets. Now, the business terminology that we use to reflect this allocation of the capitalized cost to expense over its useful life, well, if it's property, plant, and equipment, we call it depreciation expense. If it's an intangible asset, the allocation of the intangible asset's cost over its useful life to expense is referred to as amortization expense. The using up of a natural resource over its life is reflected as depletion expense. This is important business lingo, terminology. You need to know these terms and be able to recognize them. Depreciation expense related to property, plant, and equipment, amortization of intangibles, and depletion of natural resources. Why is allocation of an operating asset's cost over time really necessary? I mean, is there a principle of accounting that really mandates or requires us to do this? The answer is yes. If we have a cost of doing business, we need to reflect that cost in the period in which it actually provides some benefit. If we've incurred a cost for a truck and we're utilizing that truck up over a period of time, that using up of the truck, the cost associated with that, needs to be reflected as an expense in the period in which it gave us benefit. Now let's look at an example of this allocation of cost over an asset. In this particular case, we're talking about this truck, over this truck's useful life. We're just going to kind of continue on with the same example. And in this case, we'll assume the truck purchased in that previous example on January the 1st of X4 has an estimated useful life of 6 years, with an estimated salvage value at the end of those 6 years of $5,000. We're going to try and calculate and then prepare some required adjusting entry at the end of December 31st, X4, at the end of the first year, to reflect the allocation of some of that cost of the truck to depreciation expense for the year. And we're going to use a method of depreciation referred to as straight line depreciation. Straight line depreciation means this method is an equal amount of cost or depreciation each year of its useful life. Now, I probably ought to take a moment here and discuss a couple of things. First of all, this estimated useful life. The estimated useful life is really management's best guess of how long this truck is actually going to be retained by the business. It doesn't necessarily mean that the truck is going to wear out in 6 years. It may simply mean that we as a business simply intend to own it for 6 years and then we'll sell it and get a newer truck. I know some people who actually buy a car with the intent that they're only going to drive that car for 2 years. If we're going to depreciate that car and make a calculation of depreciation, we'll simply do the depreciation over those 2 years. But we will also make an estimate of salvage value at the end of that estimated intended useful life, or the term in which we anticipate we'll own it. For example, if you're going to own an automobile, you're buying a car and you're going to own it for 20 years, the salvage value at the end of that 20 years may be 0. But if in fact you're going to buy a car, a brand new car, and use it only for 2 years because you always kind of like to be driving a brand new car, well, the salvage value of a car at the end of that estimated useful life of 2 years is going to be a lot higher than zero. So there is a relationship in terms of our estimate of useful life, which is really our management's expected retention period for that asset, and the estimated salvage value. The shorter the useful life, typically the higher the salvage value. In this particular case, we're estimating 6 years of useful life, or the term in which management intends to keep and utilize this asset. And management is guessing. And let's face it, it is a guess. Maybe they can look at some historical records, some blue book figures given, other trucks after 6 years or something, and come up. Basically, this salvage value of $5,000 is pretty much a shot in the dark. Given all of this information now, let's try and figure out or make a calculation of the amount of depreciation expense that should be reflected in this first year of operations for the company. Straight line depreciation is calculated by taking the cost. In this case, the cost is $65,000 less the salvage value, which in this case is $5,000. If you take the cost, $65,000. Now remember, that's the total capitalized cost. It's not just the purchase price, but it was the purchase price plus all the other costs incurred in getting it ready for its original intended use. So we take the total capitalized cost and deduct the salvage value of $5,000. This is the amount of diminished value we expect over the useful life. It cost us $65,000. We think it'll be worth $5,000 at the end of 6 years. So we want to depreciate that difference, or I'm going to call it depreciable cost, the difference between its capitalized cost and its salvage value. That's $60,000. We're going to allocate that over 6 years, and the straight line method of depreciation says that we're going to allocate it equally over 6 years. So we'll take the $65,000 less $5,000, or the $60,000 that's going to be depreciated, divide it by 6 years, and we're going to depreciate it about $10,000 every year. At the end of the first year, we need to actually make an entry to record this using up of the truck, this allocation of its cost to expense. We need to record this depreciation expense for the first year. The amount's $10,000. We do that by debiting depreciation expense. It's an expense, and we debit expenses. And theoretically, we probably should credit truck because the truck is being diminished in value, and we originally set up the truck as the name of this asset. But we're not going to credit truck for $10,000. We are going to debit depreciation expense. We do want to allocate part of the truck's cost, $10,000 worth, to expense in this period. But instead of crediting truck, we're going to credit an account referred to as accumulated depreciation. What kind of account do you think that is? Accumulated depreciation. What we want to reflect here is that a portion of the truck is being used up. We want to reduce the truck. And so this accumulated depreciation account is effectively a reduction of the truck account, or a reduction of an asset account. We call that a contra-asset account. A contra-asset, or reduction of an asset account, appears on the balance sheet with the asset that it's reducing. If we're going to use this account called accumulated depreciation, which is a reduction of the asset truck, then under the balance sheet category of long-term assets, we'll show the truck at its original cost. Again, we're not making an entry directly to the truck account, so the truck account still has the original capitalized cost of $65,000. We're keeping track of the reduction due to depreciation in an account called accumulated depreciation, the contra-asset. And so we'll show both the total capitalized cost less accumulated depreciation and show a book value. This is a defined term that you need to remember. The book value of any asset is the original capitalized cost, purchase price plus any other cost capitalized, less any accumulated depreciation, which is a reduction of that asset. That is the book value, and it's the amount that ultimately appears on our balance sheet on a net basis. Now, if you had not used accumulated depreciation, this contra-asset account, and you had simply credited truck, as I suggested that we might do theoretically, you would still have a net book value theoretically on the balance sheet for the truck of $55,000 because you'd have the truck originally at a cost of $65,000 less $10,000 reduction due to depreciation. The only difference here is the amount of information that's provided to show how we got the net book value for this truck of $55,000. Now a question. Why are we using this contra-asset account rather than simply reducing the asset directly when we're accounting for this depreciation of the truck? Here is the answer. We all know that this depreciation is kind of a hokey thing. I mean, it's based on estimates, etc. So what we're going to do for those investors, creditors, ultimately going to get this balance sheet and read it, is we want to basically give you as much information as we can relative to what it cost and how much depreciation has been calculated on this asset. You see, if we simply show this second balance sheet and show the truck at a book value of $55,000, it really doesn't tell much of the story. It doesn't tell what did it originally cost, how much has it been depreciated, do I really believe in the same assumptions relative to how they calculated depreciation. So in order to provide fuller disclosure to the users of the balance sheet, we're going to go ahead and show the truck at its original capitalized cost. We're going to show the amount of accumulated depreciation and the resulting book value. And then basically we're going to say to anybody using this balance sheet, there's the information, and if you believe in the book value and think that's what that truck is really worth, great. If you don't, you may want to go out and get your own appraisal. But all we're telling you is that it originally cost $65,000 and we've depreciated it $10,000, and you can decide for yourself whether you think it really has a value of $55,000. We're just providing fuller information in terms of its original cost and how much we've actually determined in this kind of mushy calculation of depreciation. Now, let me ask you again, given this example with the truck, what would be the book value of the truck at the end of the second year? What would be the book value that would appear on the balance sheet of this truck at the end of the second year? Again, the book value is the original capitalized cost of the asset, which was $65,000, less accumulated depreciation, this contra-asset. What would be the balance of accumulated depreciation at the end of the second year? Well, since we're using straight-line depreciation, the amount of depreciation every year is $10,000, so the accumulated depreciation from the date that we purchased the truck to this point in time is $10,000 for the first year, $10,000 for the accumulated depreciation is $20,000. Let me ask you this question. Is accumulated depreciation a real or a nominal account? Remember that real accounts are balance sheet accounts, And balance sheet accounts are never closed. And because they're never closed, they maintain a continuing running balance. If we make an entry to account for depreciation, crediting accumulated depreciation at the end of the first year, and do it for every year thereafter, at the end of the second year, the accumulated running total of depreciation is $20,000. And it is a credit balance. So the book value of this truck at the end of the second year, coming back to the original question, would be a capitalized cost of $65,000 less accumulated depreciation at the end of 2 years, $10,000 a year, for a book value of $45,000. What would be the book value of the truck at the end of the sixth year of ownership? Well, at the end of 6 years, you've got accumulating depreciation every year for 6 years at $10,000. Accumulated depreciation would be $60,000. The capitalized cost was $65,000, and the book value at the end of the sixth year is $5,000. What does that $5,000 really represent? That was our original estimate of the salvage value. See, we're depreciating it down to what we think we can sell it for, or its salvage value, at the end of its useful life of 6 years. Now let's face it, at the end of 6 years, we may say, hey, this truck is really working well, we're going to use it for another 2 years, and our estimate at the end of the next 2 years is that there will be zero salvage value. You're going to just drive this thing into the ground. We would then basically continue depreciation for the last 2 years, taking that $5,000 that's book value at the beginning of that 2-year period and simply depreciate that equally over the last 2 years, and the book value would ultimately be zero. So we may modify our estimates and assumptions as we go along, but not go back and change any of our previous calculations of depreciation, but simply from that point forward, apply these new estimates in making future calculations of depreciation from that point forward. For discussion's sake, let's modify this example that we've been working on. What I'd like to do is the modification would be, let's assume that the truck that we purchased, that in fact we didn't purchase it on January 1st of the year X4, but instead we purchased it on April the 1st of X4. Now I want to prepare the adjusting entry for depreciation at the end of that first year. But notice here that it is a partial year. I mean, the first year, since we didn't buy it on January 1st, instead we bought it on April 1st, and we're going to prepare financial statements at the end of that calendar year, 12/31 X4, how much depreciation should we reflect in that partial first year? Annual straight-line depreciation equals $10,000 per year. For the first year, the truck utilization, the period that we're using the truck from April 1st on, represents 9 months of use. On a straight line basis, what we're going to do is take that first year's total 12-month depreciation, but only utilize or reflect 9 months of it. So $10,000 of total depreciation for a full year times 3/4 of a year, which was the period in which it was utilized, or 9/12, equals $7,500 of depreciation that should be reflected in that first year, given that it's really a partial year. You can see if we were to develop a schedule of depreciation expense over the life of this particular truck, given this new date of purchase on April 1st, that during the first calendar year there'd only be $7,500 of depreciation expense reflected on a straight line basis or method. Then there'd be $10,000 each year for a full year's utilization in the second, third, fourth, fifth, sixth year. That's 5 years there of $10,000 each. And then in that last year, we really only have 3 months up through the original 6-year estimated useful life. And so there'd be partial depreciation reflected in that last year of only $2,500. But the total accumulated depreciation over the estimated useful life would be the full $60,000, just as it was previously. Just different allocations given a partial year in that first year of acquisition. Now there are some other ways to calculate depreciation other than a straight line method. In fact, there's a wide variety of different methods. There are methods that instead of taking an equal amount every year, there are what we call accelerated depreciation methods that assume that in the early years of life of a truck, it's actually more productive to us. I mean, it's better. It's in better shape. It's more efficient and effective. And so maybe we should account for more depreciation in the early years. In fact, that makes sense for many of you. You know, if you buy a car that it depreciates, it probably has the highest level or amount of depreciation in terms of reduction of its real value in the very first year. So there are some other methods of calculating what I would call accelerating depreciation from the first year's higher depreciation to lower amounts in later years. And that's referred to as the units of production method of calculating depreciation. Now, let's look at this example, and basically, let's go ahead and just use the same information that we had using our same truck. Again, a capitalized cost of $65,000. And assuming that instead of a useful life of 6 years, we'll assume that the truck's usefulness is estimated at really, instead of years, 100,000 total miles. In other words, when this truck reaches 100,000 miles, that's when we're going to sell it, not at the end of 6 years per se. The estimated depreciation expense theoretically amounts to about 60 cents per mile. How did I calculate that? Well, if the total capitalized cost of the asset was $65,000, the truck, and we still believe that after 100,000 miles, I'm going to make that assumption here, after 100,000 miles, we still believe that it will have a salvage value of $5,000. So the amount that needs to be depreciated over the life of this truck is still $60,000 worth of cost. But if that $60,000 of cost is really going to be measured in terms of miles, and that's expected to be used up over 100,000 miles, we'll divide 60,000 by 100,000 miles and come up with a cost or depreciation per mile. It's about 60 cents per mile. Now, if the truck is actually driven in the first year of its operations in 20x4 for 13,000 miles, then the total amount of depreciation expense to be reflected in that year would be simply calculated at 60 cents a mile times the 13,000 miles we drove it in that particular year, or $7,800 worth of allocation of cost or depreciation expense in that year. Now, this makes a lot of sense, this kind of a technique. Debit depreciation expense, $7,800, and credit, not the asset, but the contra-asset, keeping track of the amount of accumulated depreciation for this specific truck. The amount in any subsequent year under this units of production method will vary given how many actual miles we drive in that year times the 60 cents per mile that we've calculated previously. And so the amount of depreciation will truly depend upon how much we actually utilize the asset in that year based on the number of miles driven. It probably would be wise here to also kind of go off on a little tangent and make one other mention here. You know, some companies have hundreds of delivery trucks, maybe even thousands of delivery trucks. You know, how are we going to account for that? I mean, do we need to calculate depreciation, on every single one of those trucks? And how would we do it? In most cases, businesses that have, these kinds of many long-term assets, they will set up an account in the general ledger called trucks. It's not truck because we got thousands of trucks. And they'll set up in the general ledger an account called truck. Or maybe they'll just set up one account called, equipment, meaning trucks and any other kind of machinery or anything like that. Just set up one big account. But unfortunately, each one of these assets may have differing estimated useful lives, a salvage value. They're purchased at different dates. In this particular case, what we're going to need to do is set up a subsidiary ledger that identify a separate account for every single different kind of truck and every single different kind of equipment, and keep track individually not only of what its original cost was, but also maintain a subsidiary ledger of accumulated depreciation that would equal total accumulated depreciation in the general ledger. See, I'm talking about in the general ledger an account called equipment, including trucks, and an account called accumulated depreciation that keeps the totals of all of our equipment and trucks, but a subsidiary ledger of trucks and equipment that shows the original capitalized cost of each of these individual items, and a subsidiary ledger for accumulated depreciation associated with that particular truck per se. But this is the entry that would be made. We're going to reduce our assets by crediting an accumulated depreciation, and in a computerized system, the subsidiary ledger for accumulated depreciation for that specific asset, and debit depreciation expense.